If you got a buyer sitting on the fence waiting for Washington to fix their payment, this week would be Exhibit A. The government did the biggest thing it's done in a long while on rates, and your buyer's payment moved $5.
Welcome back to the South Florida Mortgage Report. It's Billy May, your hat dude wearing mortgage guy, always joined by Craig A. Garcia, president of Capital Partners Mortgage. Craig, something happened on Wednesday morning that I think a lot of people saw a headline, but they're not really sure what happened, and they just kind of kept scrolling and they don't know what's going on. So what exactly happened on Wednesday?
Yeah, I'll be honest. When I read it, I had to read it twice. I'm like, what did they do? So at Wednesday, 8:30 in the morning, the Treasury Department put out an announcement. What they said was, we're doubling the size of our bond buyback program. It was $2 billion per operation. Now it's at least $4 billion. And it's specifically for the longer term stuff, 10 years, 30-year bonds.
So why does it matter to us? Or why does it matter for interest rates, I guess, right?
Because that's what they're trying to do, is manipulate or impact the longer term rates, which impacts mortgage rates. So that's what we're going to talk about today.
Yeah, so that's the part I want to point out. We talked about this, not this exact thing, but this idea, and we've talked about this previously, right?
We did. So we did a whole episode on the new sheriff in town.
Yeah, the new sheriff in town, right?
Yeah, Kevin Warsh, gunslinger, coming in as Fed chair. And we talked about some of the things that he might try to do. And this thing, Operation Twist, where you push down longer term rates without going full quantitative easing. So
right. And that QE, quantitative easing, let's just kind of give a quick Reader's Digest version. That was back when the market, late 2000s, right, Craig? And the government had to prop up the housing industry, basically.
Yeah, quantitative easing is where the Federal Reserve goes in and starts buying assets. They will buy bonds, they'll buy treasuries, they'll buy mortgage-backed securities, they'll buy stocks. So it's where they help the market by becoming a buyer in whatever instruments they're trying to affect the price of. And
right.
So,
right. And Kevin Warsh came in. He's saying he doesn't want to do that. I mean, we talked about this like 3 months ago. He was the new sheriff in town, right? He said specifically he does not want to do that.
Correct. He's been in favor of doing that on a very limited basis and getting out of it, but not something that he was looking to do.
Yeah. And this wasn't just Warsh, right? This was Scott Bessent, right?
Well, this actually wasn't Warsh at all. So this was Bessent. This is the Treasury, not the Fed.
Right, which is a different animal.
Yeah, it's a completely different animal. We should spend some time on that because I think that's kind of the interesting part. I want to explain the thing first because I had to work at it a little bit myself, honestly.
Okay, so give it to me like just in plain layman's terms. I'm the average Joe.
Okay, so the government spends more than it takes in. That's why we're in a huge deficit that everybody has heard about. So to cover the difference of what they're spending versus what they take in, it borrows money. And the way it borrows money, it hands out IOUs. These are treasury bills, treasury bonds. So some of those are short. Hey, pay me back in 3 months. Some are long. Pay me back in 30 years. And there's a thing about the 30-year ones is nobody's really excited about the 30-year ones right now.
Why not?
Well, would you lend somebody money for 30 years right now with everything going on?
No, not really. I mean, that makes sense, right?
You'd want a pretty good payoff to do that.
True. Yeah, that's true. I'd want a lot, actually. That's true, yeah.
And that's right. And I want a lot is the interest rate. So that's what your yield is. It's what you have to promise somebody to get them to take the longer term IOU.
Okay. Yeah, that makes sense.
So on Tuesday, that number hit 5.32% on the 30-year Treasury bond. It's the highest it's been since 2007. So 19 years. That's the highest it's been.
Wow.
So Wednesday, the Treasury says, okay, we got to do something. We're going to go out and buy back some of those old long IOUs ourselves. We're going to take them off the table. Fewer of them floating around out there. Maybe the ones that are left don't have to promise so much. So
basically the government's buying their own debt back, correct?
Some of it. And here's the part that I think is the whole thing. Where do they get the money to buy them back?
I don't know.
So they borrow it. shorter term. Okay.
Gotcha. Right.
So you think
So
about
that's kind of like paying my mortgage payment on my credit card or something.
maybe think about a kid with a lemonade stand who borrowed from every kid on the block, and some of them want to be paid back next week, and some agreed to wait for 30 years. And the 30-year kids are getting nervous. Okay.
Yeah, okay.
So mom steps in and says, I'll buy out some of the 30-year kids. And how does she pay for it? She borrows from more money from the next week kids.
Okay.
Right.
So nothing really gets paid off.
Yeah. No, it didn't get paid off. It's the whole thing. The pile got moved. It didn't really get smaller.
Okay. I guess that's a great way to put it, right?
Yeah. So, and I want to be fair, it's not a criticism of the Treasury. It's just literally what the operation is. It's a swap, long-term debt out and short-term debt in. So,
Okay. So people online, a little bit of noise online, they're calling it QE. And we kind of talked about QE earlier, right? And that's like money printing, right?
well, I got to be careful here because this is where people get, loud on the internet. When the Fed does QE, that's new money. The Fed creates it. It didn't exist before. So
Right.
that's what they mean by quantitative easing. They're just buying stuff based on money that they printed, like we were saying.
Right.
This isn't that. This is the Treasury taking money it already borrowed and kind of moving it around. It's really not new money. It's just a different pocket.
Okay. All right. So that it's smaller than it sounds then.
Yeah. And honestly, the Treasury's been running buybacks for over 2 years now. So that's not new. They just made it bigger.
And the reason for it is?
Their stated reason is liquidity, which just means that is there a buyer when you want to sell? And there's real evidence for that. Dealers have a pile of that 10 to 30-year paper sitting on their books that they'd like to move. Treasury coming as a buyer helps them clear it.
Okay. So it's legitimate.
Yeah, that part's legitimate. I don't want to be cynical about it. I mean, where it gets interesting is what else it might be.
Yeah. Well, I mean, $4 billion, man, that seems like a big number, right?
It's a big number, but let's put it in our terms, though, because this is the part that made it click for me.
Yeah.
So they're going to run 4 of these a quarter, $4 billion each, so $16 billion in a quarter. Okay. The deficit is running about $2.1 trillion a year. So call it $525 billion a quarter of new borrowing.
So 16 against 25?
16 against 525.
525. Oh,
So it's
wow.
3%.
3%. Okay. All right. So yeah.
Shrink it down to a household. Say you went out and you borrowed $525,000 this quarter, and then you turned around and bought back 16,000 of it.
Yeah. Yeah. It's not really going to change anything, right?
Yeah. I mean, it's not going to change your payment that much. And that's the honest scale of it.
Okay. Now it's starting to make sense. Okay.
I mean, because when you see $4 billion, your brain goes, hey, man, that's a huge, huge number. And that's, against your checking account, sure. Against what the government's borrowing, it's a rounding error.
Okay. It makes sense. It's not huge. So let's talk about what did the market do?
So it's my favorite part, or maybe not so favorite part. So Wednesday morning, it works. The 30-year drops about 9 basis points, the 30-year Treasury, down to 5.19. The 10-year comes down 6 to 4.64. Stocks went up. Even Bitcoin got excited.
So it worked, right?
For about a day. Thursday, all of it came back. The 30-year goes up almost 6 basis points, right back up to 525. The 10-year back over 470, basically right where it was before the announcement. So,
right. So basically the market says, thanks, but no thanks.
Yeah. And that's the single most useful thing that happened this week, not the announcement, but the fade of that.
So why do you say that?
Because the market told you what it thinks the announcement's worth. It's worth about a day. It's not worth a lot.
So who's saying what on this? Because I'm sure everybody's got some sort of take. I'm kind of curious what the prognosticators, like, what are they saying?
Yeah, I was looking around and the takes are pretty consistent, which is somewhat unusual. So there's a guy named Mohammed El-Erian, who, if you don't know, he's a very respected guy on bonds. He was at PIMCO. He's on CNBC and CNN a lot. He said the move is, I'm quoting, less about the buyback itself, which is small in both absolute terms and relative to net issuance, than about the possibility of broader deployment of yield curve control.
So can you break that down?
So he's saying 2 things. One, the buyback is small, which is just what we walked through. And two, the reason people care is what it might turn into.
Okay. And he also said something about this Operation Twist, right?
He did. He went on Richard Quest's show at CNN and compared it to Operation Twist directly, which is what we were speculating about on the Kevin Warsh episode. So that was cool.
Hey, we were projecting this a couple of months ago, right?
Yeah, that's right.
How about that?
And then he said the thing I think is the sharp line of the week. He said, if you can't address the fundamental problem, which is too much government debt and deficits and too much borrowing by tech companies, you start financial engineering.
Ooh. Yeah. Interesting. Financial engineering, huh?
Yeah. Which is a polite way of saying you're rearranging instead of fixing.
So who else? Any other people?
A gentleman named Joe Brusuelas, the chief economist at RSM, big accounting and consulting firm, he said this will prove to be, quote, a temporary salve to an open financial wound of our own making.
Wow.
Yeah.
So kind of like just a bandage, huh?
Yep, Band-Aid. And he went further. He said that Bessent's a political actor. His interest is short-term, organized around the election, which is a pretty strong political statement. I'm not saying that. I do think that whoever's in power is always doing something to impact the ability to stay in power. So,
yeah.
So that, yeah.
Yeah, fair enough. That does sound like kind of a political statement. And then anybody else?
Rebecca Patterson, so she's at the Council on Foreign Relations. She said had probably the tidiest version. She said buybacks are more signal than substance, which is not. It's not. I don't mean it as an insult or anything, but we've been saying a number of different occasions that the administration does lots of things to kind of make it seem like they're trying to do something. And
perception is everything. I think that's a good one. Like it's more signal than substance. It's saying, hey, we're trying, we're doing something, but really at the end of the result, what is the result?
It's tough. And so and it's not that nobody's defending it. So the guy David Scott at StoneX said that the announcement's not yield curve control. He said one announcement does not amount to anything like yield curve control. He's right. I mean, the program has a size and an end date, November 4th. Yield curve control is when you say we'll defend this level, whatever it takes, indefinitely. So that's not what they're doing. So
there is a real difference.
Yeah. And he also said a line that I keep coming back to. He said the deficit financing requirement does not simply disappear if yields are prevented from doing all the adjusting.
What exactly does that mean?
Meaning that the bill still comes. If you don't let the interest rates do the adjusting, something else has to. And usually that something else is the dollar.
All right. So let's get to the part that's interesting. So why Treasury and not the Fed?
So this is speculation. I'm a mortgage guy. We're not involved in any of this stuff. But, Warsh comes in at the Fed as the Fed chair. His first meeting's in June. He holds rates, and then he says something you don't hear the Fed chair say. He said, we missed on inflation for 5 years. We're going to fix that. So
that was a statement, right?
Yeah. And 9 of the 18 people on that committee are now penciling in a rate hike this year, not a cut, a hike. So the market's got September at about a 2/3 chance.
Yes, the Fed might be going up. Good chance.
So the Fed might go up. Now put yourself in that seat. Warsh spent a whole career arguing against the Fed's balance sheet getting bigger. He just told the country inflation is the enemy. He can't turn around 3 months later and start buying long bonds. His credibility is the most important thing he has going at this point. And he doesn't want to toss that. He doesn't want to impact that negatively early on.
Yeah.
So,
yeah. It makes sense. But somebody wants those long-term rates down, right?
Well, yeah, somebody very much wants long-term rates down. And the Treasury can do it without touching monetary policy at all. So it's their own debt. It's a debt management decision.
So basically, what you're saying is the Treasury is running the play that the Fed chair can't run, basically, right?
I'm saying some people are reading it that way. I don't think that reading is crazy. That Rebecca Patterson, a CFR, she made the same point from the other direction. She said one of the paths to lower yields would be Fed QE, and that's improbable because Warsh is against balance sheet expansion.
Yeah, that door is closed as far as we know, right?
I mean, it is for now, and this one's not. So, yeah.
That's a little uncomfortable.
Well, I mean, here's what makes it strange. I mean, think about what could happen in September. The Fed hikes short rates to fight inflation. Treasury's out buying long bonds to push long rates down at the same
time. Yeah.
Yeah. Same government, two different arms pulling in opposite directions. I'm not saying it's a scandal. I'm saying if you're wondering why the bond market seems a little confused right now, that's a pretty good reason.
Yeah. Interesting. So Craig, I've got agents listening, prospective clients always ask me what's going on with rates. I mean, really, what's the message? What do I tell them?
Well, a couple things. Number one, this did not change your buyer's rate. Freddie Mac's survey came out Thursday at 6.65 for the week. The week before was 6.67. So
2 basis points, right?
2.
Yeah.
So on a $400,000 loan, that's $5.30 a month. Yeah.
$5. I can't even get into a movie these days for $5.
I don't even think Subway's selling $5 footlongs anymore.
No.
So you definitely cannot get into a movie. So the entire week of headlines, doubling the program, yields dropping, coming back, $5.30. Nothing happened. Yeah.
That's a good reality check.
Yeah, and that's the lesson I would want an agent to take. If you got a buyer sitting on the fence waiting for Washington to fix their payment, this week would be Exhibit A. The government did the biggest thing it's done in a long while on rates, and your buyer's payment moved $5.
Yeah. All right. So that was the first thing. What's number 2?
Number 2, watch the 30-year Treasury, not the Fed. I think a lot of people in our business still think the Fed sets mortgage rates. The Fed sets the overnight rate. That's credit cards. That's home equity lines of credit, construction loans. Your 30-year fixed rate follows the long end of the bond market.
So if somebody hears the Fed's going to be raising rates next month and panics, right? I mean, what do they do?
You can tell them, hey, that's a different rate. It's not the one on your loan. It might not move your mortgage at all. Sometimes when the Fed gets tough on inflation, long rates actually get better because the market believes them. So
it's kind of counterintuitive, right?
It trips people up all the time. As long as we've been doing this, they hear that the Fed lowered rates and they think, oh, my mortgage rate comes down. And meanwhile, mortgage rates went up. And the opposite can happen too. Oh, the Fed raised rates. Oh no, rates are going up. And meanwhile, mortgage rates get better. So they influence each other, but not always in the way that people think, and definitely not as far as the timing goes.
Absolutely. So what's your third, number 3 here?
This one's a little bit more of an opinion. If you have a client sitting there thinking there's some big drop coming, I'd be careful with that. Rates go up faster than they come down. That's been true the whole time we've been doing this. And the 30-year Treasury is at a 19-year high right now.
Yeah. So if the payment works, basically.
Payment works, I'd be looking to secure it. That's my opinion. We don't know. There's still lots of wild cards out there. And I've been saying it for a while. You just assume and think that, hey, a month from now, 2 months from now, rates are going to be better. You might not. You might be right, but you might not.
Yeah, no, absolutely. Like you said, and I always say rates go up fast and come down slow. So I got you. So for the homeowner listening, someone who's not buying anything.
2 things I'd want them to know. If you've got a HELOC or you've got a credit card debt, pay attention to September. Those are tied to the short rate. The short rate might be going up, and that's the one that could actually hit the budget.
Yeah, that's real money.
Yep, that's real money. It's the opposite of what most people are watching. Yeah.
Yeah. Now, what's the second thing?
Second's more of a mindset thing. There's a lot of noise right now about the debt and the deficit and $40 trillion, and it's easy to get paralyzed by that.
Oh, absolutely. It's a huge number, yeah.
Yeah, I just say none of those numbers tell you whether to buy a house on a Tuesday in Broward County. Your rate is your rate, your payment's your payment. The house either works for your family or it doesn't.
Absolutely, that's true. No doubt about it.
Yeah. The macro stuff is fascinating. I clearly enjoy talking about it, but I've watched a lot of people wait out of market, and I don't think, many of them came out ahead.
No, I agree. 100%. Yeah. So how do we sum this all up?
I would sum it up like this. The Treasury did something real this week. It just wasn't big. They doubled a program that was small. So now it's slightly less small.
Yeah. Yeah, exactly.
Yeah. And the market bought it for a session and handed it right back. And nobody serious thinks it fixes anything, because the thing it would need to fix is that we're borrowing $500 billion a quarter, and somebody has to want to hold that paper.
Yeah. That's the real story.
Yeah, that's the real story. It's not a mortgage story. It's the bigger story, but it lands on us because the long end of the bond market is where your mortgage rate lives and gets derived from.
Yeah. So what are you watching next then?
So 2 dates. September 9th is when these bigger buybacks actually start. So up to now, this is just an announcement, and then the Fed meets in September, and there's a real chance that they might hike.
Yeah, both in the same month.
Same month, pushing in opposite directions. So I'd say, ask me in October, but we get a chance to wrap every week, Bill. So
Yeah, of course. Yeah. That's
yeah.
fair enough. Fair enough. So, yeah.
But Bill, let me ask you something, because you talk to more buyers day to day than I do. I mean, are people even hearing this stuff, or is it all just noise to them at this point?
I think it's a lot of noise. And there are people who are realistic home buyers that I think, well, they hear certain things. And then, of course, you get these prospective home buyers like, I'm waiting for rates to get in the 4s or 5s. And I just tell people, listen, it's been 4 years now. Okay. These is what the payments are. We're living in South Florida, a highly desirable place. And I always point out, hey, listen, I have people I talked to 2 or 3 years ago that they kept pushing it out and they're still renting, and they've really missed out.
Yeah, it's funny. And just as you said that, Bill, it made me think that that this week, it's about 4 years since we kind of started this journey at Capital Partners Mortgage Services,
That's right.
right in the teeth of the fastest interest rate, rising situation that had been happening in a long time. So yeah, it's been 4 years. So you're right.
Yeah, I know. Yeah, it's so funny. I was thinking about that this morning, as a matter of fact, because I was sitting down having my coffee, which was of course sponsored by 360 Coffee Roasters right here in Coral Springs. But and I swear, I'm thinking to myself, I'm like, what? It was 4 years. It was like right on this week. I mean, it was like it was a disaster. It was the rates were crazy. We just switched companies and we had new computers. I remember I was up in Tallahassee and I was trying to move my daughter into a new place. For me, there was a lot of stuff. It was a interesting time. Not good for rates. Remember that?
No, I mean every day. That was what was happening during that period of time, and we were coming off, a couple of years of the lowest rates that anybody had ever seen, and then suddenly we're in a situation where literally every day you would just look at the screen and open up the computer, and the rates
Yeah.
would be higher.
Yeah.
And it was like a steady march upward that made me think of the old what is it, the Price is Right game with the yodeler guy that would just go up the little mountain, the guy in the
Oh
later husband.
yeah. I love that. That was a great. I used to watch it. That was great.
Yeah, just that's what the rates were doing just every day. That's what the chart looked like. That was the rate.
That's true. No,
So, yeah.
you're right.
Yeah.
Yeah. That was brutal. And if I'm not mistaken, didn't the Fed increase, or did they cut rates in that September?
So Bill, thanks to our handy dandy friend here. What the dates that we're talking about is actually a little later than that. So this was September 24. So September 2024, Fed cut their benchmark rate by 50 basis points, which is bigger than their normal cut. And right around that time, the 30-year fixed rate mortgage had fallen about 608. It was the lowest that had been in roughly 2 years. But instead of falling, mortgage rates reversed and climbed from there within about a month. By mid-October, 30-year fixed rate was back up to around 6.52.
Oh, wow. Okay. All right. So it's only 2 years ago. Boy, time has gone by a lot slower than I thought, maybe.
Yeah,
I don't know.
but that's a
Seems
great.
like it was 4 years.
It's true, but that's a great example of what we were talking about earlier.
Yeah.
You wait for the Fed to get. So imagine you're waiting for the Fed to cut. Okay, now my rate's going to get better, and the rate goes up a half. And this happened 2 years ago. So if that's what you're waiting for, that's probably not the idea. We say it all the time. Rates don't wait for the Fed. So
that's right.
Yeah.
That's right.
Yeah.
Good point.
Yep.
Well, that'll do it. And if you're an agent and if you want help explain this to a client, or we've got a condo that you want us to take a look at, because of course there's a lot of condo stuff going on in the news. And we're got any kind of scenario you want us to look at, reach out to us anytime. We'd love to help you close more deals, right, Craig? And then we'll see you
at the closing table.
All right.
Peace out. Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.